Most Americans are told that refinancing a home is one of the smartest financial moves they can make. Banks advertise it as a way to lower monthly payments, reduce interest rates, consolidate debt, and create financial breathing room. On the surface, refinancing sounds simple, safe, and beneficial. But the brutal reality is that refinancing a home in America is often far more complicated, expensive, and risky than most homeowners realize. For millions of Americans, refinancing becomes a financial trap disguised as financial relief. What begins as an attempt to save money can slowly turn into higher long-term debt, extended loan terms, hidden fees, lost equity, increased financial pressure, and years of additional payments. And the truth is that refinancing is not automatically good or bad. It depends entirely on timing, interest rates, loan structure, housing market conditions, personal income stability, credit score changes, and long-term financial goals. Unfortunately, many homeowners refinance without fully understanding the consequences. And in today's economy, the stakes are even higher. Rising interest rates, inflation, property taxes, insurance costs, and economic uncertainty have changed the entire refinancing landscape in America. What worked for homeowners 5 years ago may no longer make financial sense today. That is why understanding the brutal reality of refinancing matters more than ever. One of the biggest misconceptions about refinancing is the belief that lowering a monthly mortgage payment automatically saves money. In many cases, homeowners refinance into a new 30-year loan because the lower payment feels more manageable. But what many people fail to realize is that restarting a mortgage clock can dramatically increase the total interest paid over the life of the loan. And for example, someone who already spent 10 years paying down their mortgage may refinance into another 30-year loan simply to reduce monthly payments. While the payment may drop temporarily, the homeowner could end up paying interest for an additional decade or more. This is one of the most common refinancing mistakes in America. Banks focus heavily on monthly payment reductions because smaller monthly payments sound attractive. But lower monthly payments do not always mean lower total costs. In reality, many homeowners refinance and unknowingly increase the overall amount they will pay to the bank over time. Another brutal reality is refinancing costs. Many Americans believe refinancing is almost free because advertisements constantly promote no-cost refinancing or low-cost refinancing. But refinancing almost always comes with significant expenses. Closing costs can include lender fees, appraisal fees, title insurance, attorney fees, loan origination fees, credit report fees, recording fees, and various processing charges. These costs can easily reach thousands of dollars. Even so-called no-closing cost refinances are not truly free. In most cases, the lender simply rolls the costs into the loan balance or charges a higher interest rate. That means homeowners still pay the costs eventually. Another major issue is that refinancing often resets financial progress. Many homeowners spend years building equity in their homes through monthly mortgage payments, but refinancing can slow that process down dramatically. During the early years of most mortgages, a large percentage of each payment goes toward interest rather than principal. When homeowners refinance into a new long-term mortgage, they restart this cycle. That means they spend years paying mostly interest again. This is why some homeowners feel like they are trapped in an endless mortgage cycle. They refinance repeatedly whenever rates change slightly or whenever financial pressure increases. As a result, they continuously restart their loan terms and delay actual homeownership freedom. Another difficult truth is that refinancing often becomes a debt consolidation tool rather than a financial improvement strategy. Many Americans refinance specifically to pay off credit cards, personal loans, medical debt, or car loans. On paper. This sounds logical because mortgage interest rates are often lower than credit card interest rates. But there is a dangerous downside. Unsecured debt like credit card balances becomes secured debt tied directly to the home. That means financial problems that once affected only credit cards now place the house itself at risk. If homeowners cannot make mortgage payments after refinancing, foreclosure becomes a possibility. This is one of the harshest realities of refinancing. Debt consolidation through refinancing can temporarily reduce financial stress, but it can also increase long-term risk. And unfortunately, many people repeat the same spending behaviors after refinancing. They pay off credit cards using home equity, then slowly rebuild credit card debt again while still carrying the larger mortgage balance. This creates a dangerous debt cycle that becomes increasingly difficult to escape. Another major problem in America today is rising home values. Many homeowners refinance because rising property prices increase home equity. And banks encourage homeowners to access this equity through cash-out refinancing. Cash-out refinancing allows homeowners to borrow against their home's value and receive cash during refinancing. This money is often used for renovations, debt payoff, investments, vacations, business expenses, or major purchases. But the brutal reality is that cash-out refinancing can quickly destroy long-term financial stability if used irresponsibly. And home equity is one of the most valuable financial assets many Americans have. Using home equity carelessly can increase debt dramatically and reduce future financial security. Many homeowners treat rising home values like permanent wealth, but housing markets can change quickly. When home prices fall, homeowners who borrowed heavily against their equity may suddenly owe close to or even more than the home is worth. This became painfully clear during the 2008 housing crisis. Millions of Americans refinanced aggressively during rising housing markets, believing home prices would continue climbing forever. Now, when the market crashed, many homeowners were trapped in underwater mortgages. Some lost homes entirely. Others spent years recovering financially. And even today, many financial experts warn that Americans still underestimate housing market risks. Another brutal reality involves interest rates. Many homeowners assume refinancing only makes sense when rates drop significantly. But lenders aggressively market refinancing opportunities even during periods of relatively high rates. This often happens because refinancing remains profitable for banks regardless of whether homeowners truly benefit. And then mortgage companies generate billions of dollars through refinancing fees, interest payments, and loan servicing. That means lenders are heavily motivated to encourage refinancing activity. Unfortunately, homeowners sometimes refinance based on emotion instead of long-term calculations. And fear, financial stress, economic uncertainty, rising monthly bills, and aggressive marketing pressure people into decisions they may later regret. Another serious issue is adjustable rate mortgages. Some homeowners refinance into adjustable rate loans to secure lower initial payments. At first, these loans may seem attractive because the interest rate starts lower than traditional fixed-rate mortgages. But adjustable rate mortgages carry major risks. After the introductory period ends, interest rates can increase substantially. And that means monthly payments can rise sharply. And for homeowners already struggling financially, this can become devastating. Yet many Americans learned this lesson during previous housing downturns. When rates adjusted upward, some homeowners suddenly faced payments they could no longer afford. Financial pressure increased rapidly. Foreclosures increased. And families lost homes after believing refinancing had solved their financial problems. Another overlooked reality is refinancing approval requirements. Many people assume refinancing is easy as long as they already own a home. But refinancing approval depends heavily on credit scores, debt-to-income ratios, employment history, home appraisals, and overall financial stability. If credit scores dropped since the original mortgage was obtained, refinancing terms may be much worse than expected. And homeowners with unstable income or rising debt may struggle to qualify for favorable rates. And if home values decline, refinancing opportunities may disappear completely. And this creates a frustrating situation where homeowners often need refinancing most during financial hardship, but may no longer qualify for strong loan terms. Anson, another brutal truth is that refinancing can create false financial confidence. Anson, lower monthly payments sometimes make people feel financially healthier than they actually are. Instead of solving underlying financial problems, refinancing may simply delay them. Naniniyen, someone struggling with overspending, rising debt, poor budgeting, or unstable income may experience temporary relief after refinancing. In but if spending habits remain unchanged, financial stress often returns. In some cases, it becomes even worse because the homeowner now carries a larger mortgage balance or longer repayment period. Nyan, this is why refinancing should never replace long-term financial discipline. It is a financial tool, not a guaranteed solution. Another major issue in America is rising property taxes and homeowners insurance. And even if refinancing lowers mortgage interest rates, homeowners may still face increasing total housing costs because taxes and insurance continue rising. In some states, insurance premiums have exploded due to hurricanes, wildfires, floods, and climate-related risks. Property taxes have also increased in many regions because home values rose rapidly. A result, some homeowners refinance expecting meaningful payment reductions but discover that total monthly costs remain high because escrow expenses continue climbing. This creates disappointment and frustration. Another hidden problem is refinancing timing. Refinancing too frequently can become extremely expensive. And every refinance restarts fees, closing costs, and loan terms. Some homeowners refinance multiple times within short periods whenever interest rates shift slightly, but small interest rate reductions do not always justify refinancing costs. Financial experts often emphasize the importance of calculating break-even points. A break-even point measures how long it takes monthly savings to recover refinancing costs. And for example, if refinancing saves $150 per month but costs $6,000 in fees, it would take 40 months just to recover those expenses. If the homeowner plans to move before reaching that point, refinancing may actually lose money. This is something many Americans fail to calculate properly. Another harsh reality is refinancing during retirement. Many retirees refinance to reduce monthly payments or access home equity. But refinancing later in life can become risky because retirees often live on fixed incomes. A longer mortgage term may create financial obligations deep into retirement years. Healthcare costs, inflation, and rising living expenses can also make future payments harder to manage. Some retirees even refinance repeatedly because they struggle with debt or insufficient retirement savings. This can reduce long-term financial stability and limit inheritance opportunities for family members. Another growing issue involves home equity dependency. Many Americans increasingly rely on home equity as a financial safety net. Instead of building emergency savings or investment accounts, they repeatedly refinance or borrow against home equity during financial stress. This creates a dangerous cycle where the home becomes the primary source of financial survival. The problem is that homes are not guaranteed ATM machines. Housing markets can decline. Economic recessions can reduce property values. Interest rates can rise. And refinancing opportunities can disappear quickly during financial downturns. Another brutal reality is emotional pressure. Owning a home carries emotional significance for many Americans. People want to protect their homes at all costs. This emotional attachment sometimes leads homeowners to make desperate refinancing decisions during financial hardship. Some refinance simply to avoid short-term stress without fully evaluating long-term consequences. Banks understand this psychology. Mortgage advertising often focuses on emotional relief rather than total financial cost. Advertisements emphasize phrases like, lower your payment, unlock cash, or take control of your finances. Indicating. But these advertisements rarely focus on long-term interest costs, extended loan timelines, or increased debt burdens. Another major reality is that refinancing benefits wealthier homeowners far more easily. And in homeowners with strong credit scores, stable high incomes, significant equity, and low debt ratios often secure the best refinancing terms. Meanwhile, financially struggling homeowners may receive higher rates, worse loan conditions, or outright denials. This creates inequality within the refinancing system itself. The people who need financial relief most often receive the least favorable refinancing options. Another difficult truth involves refinancing and consumer behavior. Ancient many Americans view rising home equity as spendable money rather than long-term wealth. Cash-out refinancing became extremely common during housing booms. And people used home equity for vacations, luxury purchases, vehicles, weddings, home upgrades, and lifestyle inflation. But converting home equity into consumer spending can weaken long-term financial security dramatically. Home equity is not free money. It is borrowed money secured by the house itself. That distinction matters enormously. Another harsh reality is that refinancing can sometimes hurt future financial flexibility. A homeowner who refinances into a larger loan balance may have fewer future borrowing options. Higher debt obligations can impact retirement planning, investment opportunities, and emergency financial flexibility. In some cases, refinancing also increases psychological stress. Many homeowners feel trapped after extending mortgage terms again and again. Instead of moving closer to debt freedom, they feel like home ownership becomes an endless payment cycle. Another major issue is economic uncertainty. In today's economy, predicting future interest rates, inflation levels, housing markets, and job stability is extremely difficult. And some homeowners refinance believing rates will continue falling. Others refinance out of fear that rates will continue rising. But financial decisions based purely on economic predictions can become dangerous. No one can perfectly predict future markets. That is why refinancing decisions should focus primarily on personal financial stability rather than market speculation. Another brutal truth is that refinancing does not fix affordability problems caused by overpriced housing markets. In many parts of America, home prices increased dramatically over the past decade. Even lower interest rates sometimes cannot fully offset inflated housing costs. As a result, many homeowners remain financially stretched despite refinancing. High mortgage balances combined with taxes, insurance, utilities, and maintenance costs continue creating financial pressure. Another hidden reality involves refinancing scams and predatory lending. Unfortunately, some lenders target vulnerable homeowners with misleading promises. Aggressive refinancing sales tactics became especially common during periods of economic uncertainty. Some lenders pressure homeowners into unnecessary refinancing simply to generate fees and commissions. Others fail to clearly explain loan terms, variable rates, balloon payments, or long-term interest costs. This is why careful research matters. Homeowners should compare multiple lenders, read loan documents carefully, and calculate total long-term costs before refinancing. Blind trust in advertisements or sales pitches can become extremely expensive. Another difficult issue is refinancing and job instability. Many Americans face uncertain employment conditions, layoffs, contract work, or fluctuating income. Refinancing into larger or longer-term loans during unstable economic periods can increase financial vulnerability. A mortgage that feels manageable today may become difficult during income disruptions. This is especially important because refinancing often creates the illusion of improved affordability. But if long-term income stability weakens, even lower payments may eventually become stressful. Another brutal reality is maintenance costs. Many homeowners focus heavily on mortgage refinancing while underestimating overall home ownership expenses. Roof repairs, plumbing issues, HVAC replacements, electrical work, landscaping, appliance failures, and general maintenance continue regardless of refinancing. A lower mortgage payment does not eliminate the financial responsibilities of owning a home. This becomes especially important for older homes. Some homeowners refinance to free up monthly cash flow, only to face major repair expenses shortly afterward. Another major issue involves inflation. Inflation affects everything from groceries and utilities to insurance and healthcare. Even if refinancing temporarily lowers mortgage payments, rising living expenses can quickly absorb those savings. That means refinancing alone may not significantly improve overall financial stability. Another harsh truth is psychological burnout. Many Americans feel exhausted by constant debt management. Between mortgages, credit cards, car loans, student loans, and rising living costs, refinancing can sometimes feel like another financial survival tactic rather than genuine progress. Some homeowners refinance simply to buy temporary breathing room. But long-term financial peace usually requires broader changes, including budgeting, debt reduction, emergency savings, and realistic spending habits. Another important reality is that not refinancing can sometimes be the smarter decision. And homeowners with already low fixed interest rates may gain very little from refinancing in higher rate environments. Others may benefit more from making additional principal payments instead of restarting loan terms. In some cases, keeping an existing mortgage provides greater financial stability and long-term savings. This is why refinancing decisions should always involve careful calculations rather than emotional reactions. The brutal reality is that refinancing is not automatically a financial upgrade. It is a complex financial decision with both potential benefits and serious risks. For some homeowners, refinancing truly creates meaningful savings and improves financial flexibility. And for others, it increases long-term debt, extends mortgage timelines, reduces equity growth, and creates larger financial obligations. Understanding the difference requires honesty, financial discipline, and long-term thinking. Homeowners should ask critical questions before refinancing. How long do they plan to stay in the home? How much will refinancing actually cost? And how much interest will be paid long-term? Will refinancing improve overall financial health or simply delay financial problems? Will the homeowner continue building equity effectively? Can future payments remain manageable even during economic uncertainty? These questions matter far more than flashy advertisements promising fast savings. The reality is that America's refinancing system is built around profit. Lenders, banks, and mortgage companies earn enormous amounts of money from refinancing activity. That does not mean refinancing is always harmful. But it does mean homeowners must protect themselves by understanding the full financial picture. The smartest homeowners treat refinancing like a long-term financial strategy rather than a quick emotional decision, and they calculate total costs carefully. They compare lenders. They understand loan terms fully. And they focus on long-term financial stability rather than temporary payment relief alone. At the end of the day, refinancing a home in America can either become a powerful financial tool or a costly financial mistake. The difference depends entirely on knowledge, discipline, timing, and realistic financial planning. And that is the brutal reality most Americans are never fully told before signing the paperwork.